Okay, let's talk about commerciality. What do we mean by that? It's this firm intention to proceed. So before a company can book a reserve, move it from contingent resource, it has to demonstrate this firm intent to proceed. It has to be done in a reasonable time frame. We talk about 5 years as being a reasonable time frame. And it has to meet economic criteria. So we have to demonstrate that it's economic before we can move across. We also have to demonstrate that we have a market, we have facilities, and we have all the legal sorts of permissions and so on before we can go ahead. So this is all associated with that commerciality. So let's just now think about economic. So what do we mean when we say a project or a field is economic? Let's have a look at this diagram here. Okay. So here I've got an operating cash flow. So basically this is the sort of the cash, net cash that we're getting from a project. You can see in the early years here it's highly negative. It's highly negative here because this is when we're doing our development, when we're actually building all the facilities, all the pipelines, drilling all the wells, doing all the activities. Over here now we've got production and we're getting positive cash flow. So we've got this good positive cash flow going through here. Our field is declining. Here, we've got another year of negative. This is probably when we did some development. We did some further development in this year, so we've got a negative net cash flow. We continue on, and here we've come to our economic limit. This is the point at which the net cash flow is negative. In other words, it costs us more to produce than we make in revenue. Okay, so what is economic? The simplest way to think about economic is the sum of all these cash flows should be positive. The sum of all those cash flows should be positive. In other words, I'm making at least $1 on all this. This is the simplest way to think of economic. In reality, quite often what we would do, or what most companies do, is they discount their cash flow. And what they do is they simply say that $1 today is worth more than $1 20 years from now. Quite simply, I could put that dollar into a bank and I'd get interest on it. So I expect to get a return from my investment. And for that, we use a discount rate. And what we do is we discount each of these cash flows so that we bring it forward to what we call a net present value. And we use discount rates like 10%. It's quite a common discount rate that's used in the business. It all varies from company to company, but we discount that flow, that cash flow. Basically, there are two forms of economic analysis that is common in the business. The first one we call future conditions, and that's the one that the SPE favors, although it does allow constant case. Now, I should say that the SPE system is used by a lot of the stock exchanges in this part of the world. For example, Singapore, the SGX, in fact, recommend the use of the SPE system, as does the Hong Kong and Australian stock exchanges. But basically what we're saying here is that the oil company uses reasonable forecast of future conditions, including costs and prices, which exist during the life of the project, the forecast case. So such forecasts are projected changes to the current conditions. So we know what we have today. What we're doing is we're forecasting what will be in the future, and we are often forecasting 20 or 30 years hence. So we're looking well into the future. On the other hand, the constant case economics, and this is used by the Securities Exchange Commission in the US. So a lot of the biggest companies in the world, the BPs, the Exxons, the Shells, would use this sort of economics in their reporting because that is required by the SEC and they're lodged on the US Stock Exchange. So that's basically a case in which the current conditions are held constant. So there's no inflation or deflation throughout the project life. So this is just flat forecast of future price and future costs. So the current conditions are defined. What does that mean? It's the average of those existing during the previous 12 months according to the SPE. And according to the SEC, they use a formula based around a 12-month first of the month average. So there are reasons why the SEC uses that, and there are reasons why the SPE prefer to use future conditions, and let me run through those. So first of all, future conditions, as I said, they're internal economic metrics, so each company will have its own internal way of doing business. Okay, it'll have its own forecasts, its own costs, its own discount rates, its own exchange rates. That will be very much a company by company specific set of assumptions. Although they may not vary hugely from company to company, they are nevertheless company specific. The thing about this is it does support the business decision to invest in the project. So the reason why the SPE likes this or prefers this system is it provides a direct link between the business decisions and the reserves. So in other words, the economics that we run our reserves on is the same economics that we do our business on. And that's very important. You want to get a link between the reserves and the way you do your business. What about the constant case? It's a simple cash flow, tests revenue against costs. We use current prices and costs and no discounting or escalation. So why do we do that, or why does the SEC choose to do that? It provides easier company-to-company comparison. All right? If we're all using the same assumptions, then of course you can compare company to company much easier. But it's in no way linked to the way we do our business. The company will use a totally different set of economics for its actual business decisions than is used for its reserves. So it's a one-off process that is done for reserves. But it does allow a comparison. There's something in the US called the Standard Measure of Oil and Gas, often used called the SMOG. It's actually a requirement of the Financial Accounting Standards Boards in the US. And it's a method that they have adopted that tries to give a standard measure of reserves value. It relates only to the proved reserves and is based on those four assumptions in there: the average previous 12 months prices are held constant, the costs are not escalated, and there's a 10% discount rate. So in the US, they have gone out of their way to try and put a value on reserves that is comparable to company. But as I've said before, this may give you a comparable measure, but is not representative of the true, or at least the business case value. The SMOG is based on proved reserves only. The proved reserves, I didn't really talk about uncertainty, but the proved reserves for an oil and gas company are the conservative case. They are the low case reserves. They're what often we call them the banker's case. They are kind of the case that you're certain of. Sometimes we say, well, we should have a 90% certainty that we're going to recover at least that amount or more than that amount. So it's a very low case. So this SMOG is not representative of what we'd base our business on, because our business almost certainly will be based on the mid case. This is what we expect, the P50. So again, it gives a comparable reserves value, but does not really relate to the way we do our business.
Now, Eddie, let's bring you into the conversation here, because you head the part of the Gaffney, Klein and Associates business that looks at acquisitions and divestments. And I assume the sort of discussions that Tony's taken us through us here are your bread and butter in the boardroom. Can you paint the picture for us what these conversations usually look like?
I think if you start looking at a company like Tony said, I think the starting language trying to assess a value of company would be the reserves report. Reserves, contingent resources, and prospective resources. I think when you're in a board, the immediate question is, how much do we pay for this company that has underlying oil and gas properties? And then you start to dissect the beast by asking what constitute those values. I think in boardrooms in general, and also taking my experience back in Shell when I was working in the Netherlands, reporting to board members on why we're going to acquire, say, a company in Australia, you ask yourself, where do these volumes reside? Because to members of the board who are more familiar with this kind of classifications, then in their mind, they can put a so-called slant on how much value they put on it. You would definitely put on more value for something which is reserves, for the reasons that Tony has summarized, because there's past economic tests, so theoretically you would have much more economic value, contingent resources less so, and prospective resources. So I think in board situations, they will start with reserves, but then they will also look at the bigger picture, because some companies might acquire another company not just for reserve's sake, but might require it for contingent resources. Let me give you an example. When I was leading an acquisition of an asset in Australia, My parent company basically looked at contingent resources because they were looking at an LNG project, which may not materialize, next 2 years, but has a longer term perspective. So it all depends, but it starts with reserves, basically. Yeah.
Okay, so by the way, you just said 2 years. So can we take that as a reasonable time frame for commercialization, or does it stretch out longer than that?
Oh gosh, I think this is a very tricky question in this day and age. I think if you look at the Australian LNG projects, they've been talked about, I think, as long as I was a wee lad, so to speak, in university. And some of them have been talking about LNG projects that spend a long time, 5 years, 10 years. I think as my friend would classify LNG projects as mega projects, anything that's more than $5 billion in capital expenditure. They somehow take longer than expected. There's always delays. Plus, of course, you complicate that with good things like environmental concerns, and as you can see, market changes. Look at LNG projects in Australia. Last year at $100 world, everybody said, yes, it's gonna go. Now with the oil price wobbling down to 60, some projects get postponed. So 2 years it's not a hard and fast number.
Okay, but we as investors here, obviously Tony was just saying something has to be commercialized within a reasonable time frame. That was your word. And also you can't just say reserves as volumes. I think the thing that I really learned from you today, Tony, was that it has to have a time limit as well. So again, is there something that you can help us with in terms of a yardstick for what an appropriate time limit is?
Well, firstly, the SBE talks about 5 years. That's the sort of time limits they talk about. In reality, some projects, some parts of the world, you can have projects that are reserves that actually have a longer time frame than 5 years. 5 years is a recommendation. It's not set in stone. And the way I've been a reserves manager in an oil and gas company, and what we always say is that basically any project that is not going to be brought into development in 5 years, then you need to give very good justification. And there are justifications. Some of the companies in the Middle East, some of the national oil companies, have so many projects, and they are limited by, for example, OPEC quotas. So some of their projects simply are fantastic economic projects, but they're not going to come online for 10 or 15 years. So there can be exceptions to that 5-year rule.
Right. So as investors, if we hear a company say we have reserves of X, your counter question must be, in what time period? Is that a fair assessment?
That's a fair assessment. One of the things that companies determine, of course, is of their reserves, how much is developed. So that's what we're producing today, and how much is undeveloped. Now, that may or may not be included in reports, in annual reports and so on. So that may be information you have available. I would say if it's a investment package, then it would certainly, I would think, be in there. I'm looking at Ed here, but I would thought so. So the first part of the thing you can look at is how much of these reserves is currently producing, developed, and how much remains to be developed. And then when you start looking at that development, you can start thinking about, well, what is the time frame that that's actually all going to come online in?
Leading acquisitions and divestments at Gaffney, Klein and Associates, you've got a foot in each camp, depending on the client you're working with, I suppose. When you're negotiating about price on the buy side, what is it that you push the most? In other words, you're looking to acquire, therefore at a lower price. Where do you kind of poke holes and say, yes, but this shouldn't be as high as it is, and therefore, you should give us a discount on the asset? Take us into the tent and kind of explain that to us.
I think you basically answered my secret recipe, Mark. I think if you're coming on from the buy side, I don't have to use GCA when I was working for Shell, for example. The approach is simply to say, we'll pay you what is the realistic price at that time, right? At a point in time where we feel that the gas price, so if you're in a country like Australia or Canada, where the gas price was maybe $3 per MMBTU, sorry, that's all we can see right now. Of course, a company like Shell or Exxon or whatever, who take over such volumes, they could do a lot more things to it than selling it domestically. That's why you get $3 per unit. You get $10 selling it to Japanese, for example, LNG. But of course, in the negotiation situation, you're not going to give that away.
Except now you will, when you're on the sell side,
right,
where you'll say, hey, come on, if you buy this asset, you'll be able to do so much more with it. Isn't that what?
Absolutely.
Is that the lever that you push?
Absolutely. And this is where the buy side guy would need to know what the trick on the sell side guys would come at. And they'll say, look, this is Australia, everybody's jumping in, LNG is going to go, before $100 price crash, it's going to go land at Tokyo Bay at $15 per unit. If you sell it from Australia, it's going to be about $10, $12. You got to be kidding me, buying at $3. So this is where the fun begins. And there's the price point is obviously one where you can either structure it. You say, okay, we'll give you more money. If the project materializes into an LNG project, maybe we'll give you some money down the road, but not upfront. Because, like Tony said, the reserves is based on current conditions and situation. So if the independent resource consultant cannot see a line of sight to $15 per whatever unit, for the gas, as a buy side, I'm not sure I'm going to volunteer to pay more, unless there's a strategic reason, but of course not.
You do realize that all of these points are going to come up at AGMs from now on, right? We're going to be asking that question. How come you're selling it so cheaply when the buyer is able to make so much more with the resource? Tony?
Yeah, can I just make a comment? You mentioned there about oil companies being reluctant to release their assumptions. You've got to remember that to an oil company, the assumptions it uses in its economic analysis are very commercially sensitive. In fact, even within the oil company, it may be only a limited group of people that even know them, because that's the basis that they will look at things like acquisitions, mergers, all those sorts of areas, and their own valuations of certain areas, assets, and so on. So they are very tightly kept secrets, to be honest with you. Where it gets interesting is if an oil and gas company or the board requests an auditor like ourselves to come in and audit their reserves. Because then you can get companies who say, well, you can audit our reserves, but in actual fact, we can't let you have any of the assumptions we used for the economics. And there we get into a little bit of a circular thing. So in the end, we will usually say, all right, we will use our oil price forecast, for example. And of course, can come up with different numbers. But basically, an oil and gas company will consider those assumptions very, very commercially sensitive.
And I think we all have a reasonable appreciation of that. The only problem, Tony, is it doesn't help us as investors.
I totally agree, and I totally agree with you, Mark, that looking on as an investor, your line of sight is through the financials and information that the company puts out. But like Tony said, having worked in a corporate setting, that's the sort of information that could reveal something that you did not intend to. Because if, let's say, the company knows that you behave and make your plans based on $60 world, and then if they go in a competitive process with you, they might just pip you by a few dollars. Yes. I mean, many years ago, I remember working with Gaffney Klein the first time around. Most of us in the market couldn't figure out why in the world were the Chinese creaming us in the market. The Japanese were big in acquisitions, and suddenly the Chinese turned up. But then after a while, digging around and working with them, you find out that they use certain assumptions that are different from everyone else, like the discount rate or the oil price. So something fundamental and that can really shift things in your favor commercially. That's why, again, companies are reluctant to put it out there unless they want to be bought out or do something else.
Yes. But you see, this my job here is to make sure that we get some answers for the people. So you can't sit on the fence. What questions should you be asking at AGMs or analyst briefings or whatever it happens to be in order to come to grips with, they might not tell you outright what the assumptions are, but how can you come to grips with roughly what they are?
I feel very much on the spot here. Ed, surely you can answer this, what I think.
All right, hopefully you'll be finding me. I think one of the questions you can ask is, where do you see the oil price going? Where do you see the commodity price going? It's a fair question, really. I mean, like Tony pointed out, the reserves that they report is based on something, and fundamentally it does tie back to oil price or commodity price. So even if they can't give you the specific number, ask for some general guidance. They'll give you some idea on where this company is basically looking at things. May not give you the exact number like 65, but if they give you a range, 60 to 70, that's not bad, versus a $100 world, which is completely off from what they're looking at. So some guidance, I think they should be able to release some of that.
Well, let me tell you as a journalist, they won't. So here are three questions that you need to do in order to get there. The first thing is you say, don't ask them, where do you think the oil price is going? Sorry, Eddie. You say, do you think the oil price is going to go up or down? What do you think they'll say, up or down? Up. Let's just say they'll say up, okay? Then you ask them, how far? Okay? And the third and the final question is, because they'll say, a little bit further up. And the third and the final question that you need to ask them is, $100, yes or no? $100 a barrel. We're at 58 today. And then you can kind of see what they say, because chances are they'll say, oh, no, far less than that. Bang, gotcha. So it's going to be 65. right? So you've got to be tricky in the way that you ask these questions too, otherwise you don't get the answers you're looking for.
Zeroing in on proved reserves, I know there's different classifications, but now increasingly in the US they're talking about drilled, completed, but not producing. So I'm just wondering, maybe a question to Eddie, how would you feel, is it a different valuation if it's a reserve that's developed producing, or they've developed it, or they've drilled it and they're not producing it? Is that something that you should be valuing differently when you look at companies? The second question is, the other big valuation driver that could affect equity holders, particularly in the US going forward, is how the banks react. So we've seen in Tony's presentation about the SEC guidelines and SPE, how do the banks react? What are they going to use in terms of price forecasts, and how much are they going to write down reserves and potentially decrease their lending to some of these shale producers in the US?
I think on the first one, if you've drilled it and you don't produce it, then the first question is you should ask the reserves consultant, why do you call it reserves? Now, if it's some other reason, either for infrastructure or things like that, if there's infrastructure is not available, but all you need to build is something coming along the way, but then it comes back to that commerciality point. Is it commercial for a reason? That's very important.
Yeah.
And
perhaps I could just answer that. That classification you're talking about, or sub-classification, is a requirement, is a sub-classification under the SPE, and it's not producing or behind pipe, we call it. And remember, reserves are at a moment in time. So what you do is, on a producing oil field, you look at all those wells that are online at the time which you actually do your estimate. And those are your producing. And then you'll have a number of wells that are not producing for various reasons. And it depends on the reason. The reason might be mechanical problems. You'll have a list of wells that are awaiting repair. And that's all it is, purely mechanical, part of your operating cost. You'll have other wells that may be shut in for other reasons, and that's where you start now. This is where getting that information is going to be difficult, because they could be shut in because they've watered out, for example. And they could be shut in because they're not economic, exactly. So the problem is that you see that classification, but you don't know the reason. If you know the reason, then you can start valuing one way or the other. But it's one of those things where, what assumption do you make? Well, the assumption would be, number one, is they're not quite as good as producing wells. But you don't know how much to devalue them by.
So just to add what Tony was saying, so again, it depends on what reason why. You might place some value to it if it was purely a mechanical function, and maybe unfortunately the market is such that you didn't have any workover rigs. This could be quite serious, is that if you especially got a large area where your neighbors are off, doing the same, it's simply down to that. So actually trying to understand that, but I agree with you. If you were looking at a valuation perspective, you may not put it as high as something that's producing or ready to go, basically. Yeah, still might give some value, but the discount that you give to it would definitely indicate lesser value than producing. Now to the second question about banks, what price would they use? I think, I used to work in a bank, so I should be able to explain this. I think banks in general, if you're talking about the typical reserve-based lending, the price tag that they use is never what you see out there and everybody's talking about. Let's say it's $100 world, banks will lend you at about $65, $70. So if it's where it is 60 today, I guess banks would come down proportionally, roughly. The issue with this kind of situation is that it puts them in a bit of a disadvantage, because if they want to get into projects, the lenders would probably say, hey, look, you're being uncompetitive. Look at that curve that Tony is showing. If you just draw a straight line, it's going to go up to 70. So banks are a bit of a pickle. And because, this time around, my view is that the oil price crash hasn't coupled with a global financial crisis, touch wood. So there are banks out there who can lend. I think there's some banker friends I see out there as well. It's probably hiding themselves. So, but then the price would be conservative, I think, to start with. And I spoke to my banker friends. The answer they give back is so scary. It's just like consultant. It depends. It really depends. They're not going to say, it's 70% of what it is today. It really depends.
You used to work at Standard Chartered, right?
That's right.
So are there banks which are perhaps more risk takers? Let's say the Russian banks or the Greek banks. They have a lot of money at the moment.
I think this is the sort of situation. The banks who could quantify the risk, banks who've got engineers or geologists, My previous shop, I used to be an engineer, so we had an advantage when we looked at projects, we could access the risk. So let's say a reserves consultant gave us a report and say it was reserves. I still need to understand why it reserves, and having technical background and all that helps quantify that for the bank. How much do we actually lend based on that? And we can give you a separate talk about this. But there's some discounts based on risk mitigation and all that. Now, Russian banks, Chinese banks, when they say they do project finance, in my humble opinion, it's actually financing a project. It's not really project finance. It's actually name lending. Yeah. I mean, sorry, but hopefully
In other words, they don't have the expertise to do.
They don't have the expertise. They lend to a project because it's more or less corporate lending. It's not really classic project finance where you really assess the risk of the projects and all that. Now, if you are flush with liquidity, I've observed there are banks who are really keen to get into this space of lending to upstream projects. Not sure now, but maybe still are. They will still want to come in, but they'll probably do it together with a bank that can help structure the facility based on the technical risk that they understand and see. So yes, very keen. They'll give competition to the traditional reserve-based lending banks like Standard Chartered, BNP Paribas, et cetera. But they probably find it a challenge to go in and take it on as strictly project finance.